There are a lot of ways to make money trading stock options, and it's pretty well known by experienced traders that selling options is more profitable than buying them. However, there is one strategy that does involve buying options that can be very profitable. However, it's not just any options, longer dated options. It's called the LEAPS option, and you can make a lot of money using this strategy. In today's video, we're going to cover what is a LEAPS option, what is a poor man's covered call, what is the setup we look for when buying a LEAPS option, how do we buy a LEAPS option and make a poor man's covered call option trade on the option trading platform, and finally, what are the benefits of LEAPS and poor man's covered calls. Hey guys, Darren here. We've got a great video for you here today. However, before we start, if you appreciate the research and effort that goes into making videos like this, all I ask is that you hit that like and subscribe button below. I really appreciate it as it really helps out the channel, so thank you very much. Today, we're covering the LEAPS and poor man's covered call option trading strategies. You can make a lot of money utilizing these strategies while risking very little. I think it's super important that we understand the ways that the rich are getting richer, the strategies they're using, so that we can use those same strategies and profit in any market. Also, be sure to download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What is a LEAPS option? The long-term equity anticipation securities refers to publicly traded option contracts with expiration dates that are longer than 1 year and typically up to 3 years from issue. What is a poor man's covered call? The poor man's covered call is a bullish options strategy that is an alternative to the covered call strategy, requiring significantly less capital to trade. The poor man's covered call reduces the capital margin requirement of a traditional covered call by replacing the long stock with an in-the-money call option in a long expiration cycle. It's basically just buying a LEAPS option and then selling a shorter-term monthly call option against it. That's why when we're covering the LEAPS option, we might as well just cover the poor man's covered call. What is the setup that we look for when buying a LEAPS option? When buying a LEAPS option, we look for an undervalued stock we think will go up in price over time. When the stock price moves up, the option price moves up, and we can then sell it for more than we bought it for, with the difference between the prices being our profit. So we want to buy a stock that is down and undervalued and expected to move up quickly. For this trade, we're going to take a look at DraftKings, ticker symbol DKNG. DraftKings offers multi-channel sports betting and gaming technologies, powering sports and gaming entertainment for operators in 17 countries. They are the largest online gambling outfit next to FanDuel. Typically, they take 20 to 30% market share in every state they go into, and eventually more and more states will open up to legalize online gambling. Why? Because the states need the tax dollars. DraftKings revenue per player is increasing rapidly. If we look at the chart, we see that the stock price hit the $70 range back in early 2021. It then dropped as it had very high expectations and missed on some earnings numbers. There was also stiff competition from FanDuel and others. You can see now that since the beginning of the year, DraftKings has been trending upward consistently. It's attractively priced at just $35, which is only halfway to the $70 range that it was at previously, so there's a lot of room to run still to the upside. In looking at the income statement, we see that revenue has been increasing steadily year over year, and the balance sheet is clean as well, with assets well above liabilities and increasing steadily. How do we buy a LEAPS option and make a poor man's covered call option trade on the option trading platform? You can do this on any option trading platform. However, Tastytrade is one of the best and most intuitive for trading options. These are the guys that developed the TOS, Think or Swim option trading platform, and then sold it to TD Ameritrade, which is now Schwab, and they still use that platform today. Tasty Trade is even better. Use the link below and get cash back when you open an account. You can open an account with any amount of money. However, I do recommend about $5,000 so you can make several trades. If we punch in DraftKings in the upper left on the trade page, we can pull up the option chains. Click on the January 2025 option chain and open it up. It's 432 DTE, or days to expiration, and we want to look at the chain between 1 and 2 years to expiration, so this is perfect. The stock price is currently trading at $35, so we'll buy the 25 deep in the money call option by clicking on the ask. The cost is $14.40, which is the mid price. Since one option contract controls 100 shares of stocks, this is really $1,440. However, if you were to buy the 100 shares of stock outright, the cost would be the stock price of $35 times 100, or $3,500. So it's less than half the cost to control the same number of shares. Switching to the curve mode, we can see that as the stock price increases, we profit just as if we own the shares outright. Now there's one more thing that we can do to lower our cost even further. We can sell a call option against the LEAPS option. If we go back to the option chain again, we can open up the shorter term December 15th chain that is 33 days to expiration. The nice thing is that selling a call utilizes no additional buying power. It actually decreases it to $1,330. This is because the LEAPS will increase in value more than the call will decrease if the stock price increases. And we're protected to the downside as well, and our broker knows that. We go to the 37 call since it's a 36 delta, and we can collect $1.10, or really $110, for selling the call option. We generally want to be somewhere between 20 and the 35 delta to collect a good premium while still giving ourselves some room to the upside for our LEAPS option to increase in price as well. By collecting $110, we bring the cost of the overall trade down to $1,330. It's the $1,440 cost for the LEAPS option minus the $110 collected for selling the call. Here are the results from selling poor man's covered calls in DraftKings in one of my accounts over the last year. You can see that I've made $1,498 over the last 365 days. So I know for a fact that this strategy does work, and it's worked very well in DraftKings over the last year. So let's summarize. What are the benefits of LEAPS and poor man's covered calls? There are actually several benefits to trading these strategies. We control shares for less than half the cost. As shown, we can control 100 shares of DraftKings by purchasing the LEAPS and placing a poor man's covered call for $1,330. It would cost more than double and about $3,500 to purchase 100 shares outright. So it's a great strategy for smaller accounts. We also collect monthly premium through selling the call option. We do this against the LEAPS option, and it doesn't require any additional buying power. We also make money on both sides no matter the stock price direction. If the stock price increases, then the LEAPS option increases and we make money. If the stock price decreases, then we make money on the call side. We also potentially can control 100 shares of stock for free. By trading poor man's covered calls for the long term, you can often actually control those 100 shares of stock for free within about a year. If you were to collect $110 each month for 12 months, you would collect $1,320. If you remember, the original cost for the poor man's covered call was $1,330. So you're only $10 short of controlling the 100 shares for free within a year. However, keep in mind, some months the price of the LEAPS will have moved up as well. So you could and likely will make more money than that, since the whole premise was to buy the LEAPS in an undervalued stock that we believe will move up in price. Lastly, we can close the trade at any time. Just because we're buying a LEAPS that's 1 to 2 years out in time, or days to expiration, it doesn't mean that we need to hold it that long. Just like stock, we can sell to close our trades at any time prior to the expiration date and keep our profits. With the bull market just now beginning and 2024 earnings expected to be much better, I think high-tech growth companies that are down should really be a boom, and many of them should double. So LEAPS and poor man's covered calls are excellent strategies for this market that we are entering into. All right, guys, if you're a beginner and this sounded a little bit confusing, don't worry. It did for me as well at first. We will continue to cover option trading, tips and tricks, and different details in future videos. So we'll learn together. I put a link down below for the free options workshop. Remember to grab that. Also, please hit like and subscribe. Make sure you're informed of upcoming videos and we get this video out to as many people as possible. Please leave a comment below. Let me know any questions that you have and I will be sure and respond. Let me know what you would like to see in future videos. Thanks for watching. See you in the next one.